Yesterday, our big interview guest on Money Life gravitated towards the dark side, the doom and gloom scenarios. Today's big interview guest, he's just not going there.
If you go with the numbers, you got to stay in equities. You got to stay on the short end of the curve in the bond market, if you believe those rates are going higher. And, I'm just not buying into the doom and gloom scenario. And I think this tariff thing will work itself out because it didn't work. It's not working. I mean, it wasn't broke and Trump tried to fix it. So I think that'll blow over. Yeah, we might have a few more headline risks, but by and large, I would say I think things are intact.
That's John Lekas, President and Senior Portfolio Manager at Leader Capital Corp. And he's making his debut on the show, and he's optimistic that the market will work through its troubles and that it has 5 to 10% to go on the stock side for the remainder of this year. But up first, Todd Rosenbluth, head of research at Vetify, here with his ETF of the week. And later, Kelly Wright, editor at Investment Quality Trends, is here talking value stocks in the market call.
My little party's just beginning.
Welcome to the party, pal. This is Money Life for May the 29th. Thank you so much for being here. This show is going to help you understand why we say you don't get whipsawed by the day-to-day emotions and you want to find courage of your convictions. Because yesterday you heard some dour predictions from Larry Kotlikoff, professor at Boston University, founder of Maxify. And today you will hear some other stuff. And I will tell you, I am reticent to have anyone say the president's name in that first quote. And we had a couple of people yesterday who felt, and I had warned you about this, that Larry Kotlikoff went a little far politically. And he did, from the standpoint that I don't think we need to be calling names or whatever. Some of you said, well, we should have edited the show. No. If you heard Larry say those things yesterday and were inspired to write, and you said, well, once I heard that, I wrote him off. Okay. But if we had removed that and you'd heard the rest of it and you had said, I'm worried, I hear what he's saying, and it scares me, and you didn't have that political reference, even though I would tell you don't let the politics do anything with your investment side of things, you might have created the false impression. So we're going to give it to you warts and all. Again, we don't really want to get political, but it's all wrapped into it. And you'll see that today in the market because the trade court struck down the tariffs. I recorded that interview with John Lekas before we got the news out of the trade court. So I want to take this time right now to fill you in on what happened and give you good details on what this all means and what we can take out of it. So this was a twist we did not expect, but the Court of International Trade, which is based in Manhattan, which basically oversees all of the trade kinds of issues in this country, ruled in favor of a group of small businesses and a group of Democratic-led states that had filed suit suggesting that President Trump had overstepped the bounds of his executive authority by invoking the International Emergency Economic Powers Act of 1977, IEEPA, in case I have to say it again. IEEPA does not mention tariffs, but President Trump had invoked it, saying this is why we can justify the tariffs, the levies that we're putting on foreign countries. Now, the Constitution, as I understand it, delegates the power to set tariffs to Congress, but Congress has specifically delegated authority to the president to set tariffs in certain cases, like when there's a trade treaty violation. So the question that was before the court, which has jurisdiction over all trade issues and all tariff issues, was whether IEEPA gave President Trump the power to set unlimited tariffs on goods from nearly every country in the world. The court wrote that it does not read the law to confer, quote, such unbounded authority, and it then set, unquote, and then it then set aside the challenge tariffs that were imposed under that. So the decision applies to the flat 10% tariffs on trading partners, the so-called reciprocal tariffs, the tariffs that are tied to fentanyl enforcement against Canada, Mexico, and China, tariffs on steel and aluminum which were imposed under a different authority, right? What's the reason why I'm imposing these tariffs? That's the authority that grants the thing. Those are not affected by the ruling. And of course, the market, well, market's been super reactive when it comes to tariffs, right? So the market reacted very positively. You should expect that today the market's going to at least open way up, if not be strongly positive the whole day, because overnight action was very, very busy. Investors had held out the possibility that there would be a ruling against the tariffs as part of their market risk. Now we'll see the stock market kind of exhale and say, okay, maybe we're not going to have the tariff situation, but you should understand the tariff overhang is still going to be there, because we will wind up seeing what happens and how President Trump responds to this. You can expect a fight, but whether the tariffs will go away and how they will be applied and what have you in the interim, there's a lot of things that are very unclear. I don't think the market is going to look at the tariffs as having been resolved by the courts, unless you believe that President Trump is going to step away and say, okay, fine, I don't care. And yes, there was talk yesterday about taco, Trump always chickens out, etc. And he could say, okay, look at how well the market responded. You guys don't want this, so I won't do it. But I don't think that's really what's going to wind up happening here. So we still have to deal with it, but it is changed. But it doesn't change the comments that we got from John Lekas in all of this, but it will impact things over the next few days. Maybe it'll become less of a source of discussion, and I would not mind that. Let me know what you think. I do appreciate the folks who were writing me yesterday after the interview with Lawrence Kotlikoff. But again, we're not going to start editing out, oh, I hear this and it might set some people off. We can never do that. We give you the questions and the answers, and we don't cut them down and do that. And we don't ever really want to get into that. That's not our role in this. We want to inform you. And if somebody says something, I don't care what it is, if somebody says something that you consider disqualifying and we edited it out, you'd have a false impression. And that we don't want to do. You're welcome to respect whichever experts you want. And you're welcome to tell me, go seek out people that have opposite opinions to that. We're not asking questions that we expect that response here on the show necessarily all the time. We get it. Sometimes it surprises even me. We're going to try to go get good experts, whatever their politics. And then sometimes their politics come through. Sometimes they don't. Again, Chuck at MoneyLifeShow.com is how you reach me right now. Let's reach into today's show. It's Todd Rosenbluth, John Lekas, Kelly Wright. It's a great day to live the money life. And you'll know that for sure when the talk starts next.
To navigate today's complex market, investors need accessible, quality research. VettaFi offers free webcasts from portfolio experts and industry leaders. Earn CE credits and take your portfolio to the next level. Go to etftrends.com/webcasts and learn more.
One fund on point for today, the expert to talk about it. This is the ETF of the week. Welcome to the ETF of the week, where we get the latest take from Todd Rosenbluth, head of research at VettaFi. And if you go to VettaFi.com, you'll find all the tools you need to be a savvier, smarter ETF investor and to get more details on the new, newsworthy, trending, and timely ETFs that we talk about here. Todd Rosenbluth, it's great to chat with you again.
It's great to be back, Chuck.
Your ETF of the week is
The iShares U.S. Thematic Rotation Active ETF, THRO.
THRO, the iShares U.S. Thematic Rotation Active ETF. A lot there, but this would certainly seem to be a fund for the times, actively managed, willing to rotate, looking for signals. Is that all why this is the ETF of the week?
So that's part of the reason why. So I'll come back to what you said in a second. But the main reason this caught our attention is this is now a almost $4 billion ETF. In the beginning of the year, this was a $15 million ETF. It gathered $3 billion, or $3 billion went into this ETF following a BlackRock model allocation change last week. I figured it's worth us diving in as to why that might have happened, what investors that are using those models, advisors are using BlackRock's models. They have $160 billion that are tied to their model allocation strategy, what this means for investors. But this is an actively managed ETF, active large cap ETF. You pay a premium. Let's get that out of the way. It's a 60 basis point fee, but it's performing well and above the broader benchmark.
But that's an interesting thing too, because again, this is a fund where virtually all of the money is in new, yet it's been around long enough that it's got a 5-star rating from Morningstar and it's got a couple of years of track record. So is the track record relevant when there was not really any money in it?
So yeah, I mean, this was a live fund that in the last 3 years plus has outperformed the S&P 500. That's actually what it was, we believe, what it was replacing within BlackRock's model allocation strategy, that BlackRock reduced exposure to IVV, which is their S&P 500 ETF, and rotated into actively managed, or this actively managed ETF, a couple of other ones as well. But yeah, the track record is relevant. It doesn't matter if people aren't investing. They perhaps should have been. They would have been rewarded. Now time will tell if 3 years forward, they will be happier with this change. But yeah, this is a fund that outperformed. It did what it was supposed to do. It's warranting getting investor attention, getting the assets. Let's talk more.
Let's talk about what this fund is supposed to do, because thematic, rotation, active management, those are the 3 pillars here.
Yeah, so thematic rotation is their way of, this is a large cap. It's leaning on a way of looking at the strategy and using earnings trends, using other factors that are to help BlackRock's active management team, the iShares management team that's behind this fund, help them sort through the universe of stocks. So there's roughly 200, 250 or so stocks that are in the portfolio. So it is a subset of the large cap universe. You know, the S&P 500 is, of course, 500 companies. This is a subset of that overall universe, and you get some of the same overlapping companies that you'd find within the large cap space, NVIDIA and Apple and Microsoft. But based on the themes that are in focus, Boston Scientific, Costco Wholesale, those are other top 10 holdings within the portfolio.
Let's talk about the methodology just a little bit, because when we hear about a fund that puts rotation in the name and thematic rotation, well, themes, they don't necessarily change super quickly, but right now there's a lot of turmoil and a lot of stuff going on. So it is important to know how responsive a fund is, and is part of the attraction of this fund that it is active and dynamically responding to themes, whereas a rules-based passive approach would be like, hey, we check every quarter to see if we want to rotate. Is this about more active rotation? And is that a reason to watch, given that we just watched the market get bounced around pretty hard beginning of April to the end of May?
Yeah, so a few things that you're saying. Yes, this is dynamic. There is not a set time period when the portfolio is to rebalance and is set to rebalance as a quarterly or semi-annual, the way that we have some of those smart beta index-based strategies. Of course, the S&P 500 barely makes changes. There's a low single-digit turnover that happens on an annual basis. Companies will go in and out, mostly on the periphery, companies that either got acquired or they no longer met that criteria. But this is focused on long-term structural forces and evolving trends. So I think what we're going to see in the portfolio is going to have the potential to move over time and move based on what's in focus, as well as the valuation characteristics. This is allowing investors that were in the S&P 500 a active alternative to have within their broader portfolio. But this is, I don't expect this portfolio to change day to day, week to week, overnight. I think we're still going to see some of those heavy hitter large cap companies that I touched on be in the portfolio when we come back to this in 3 or 6 months.
If you are an active investor, part of what you are trying to do is not strap yourself to the roller coaster. And anybody who's been an index investor, man, the big decline in April and the big run up in May, well, the market may have gotten you back to basically even, but you don't feel like you're even. You feel like you've just been through a trauma. So do you believe that the key feature here might be the ability to mitigate that downside risk? Because the problem with active is sometimes that you see that decline, you make moves, and then you're not there for the period where the market comes back. So how do you weigh this? And would you say that this is a fund where if somebody's interested, offset the active with the passive in this case?
So I think what we're finding is that folks are blending active and index-based strategies. And so this ETF from iShares could pair well with the S&P 500, with IVV if you wanted to stay within the iShares family, or of course there's State Street and Vanguard S&P 500 based products. But THRO, or Throw, it's easier to say that than spell it, has the nimbleness, the flexibility, the active approach to have a chance to outperform, and as we've seen, outperform both during up times and down times. And it's doing quite well this year as well, despite having a much more volatile marketplace.
Yeah, the fund has been basically, flat up to the point where we're recording this, which the market has been more or less, just that the market has been through the big conniptions as it responded. That all being the case, given that you're looking for thematic and rotation and that the strategy is different, is this the kind of thing that's a permanent allocation, that it's not so much about the times, it's about the strategy in all times?
Yeah, so if you are a strategic investor that's not looking to make major moves, then this can be a core part of a portfolio, we think can complement an index-based approach. Whereas some of the more narrowly focused thematic strategies that are either on artificial intelligence or healthcare technology, robotics, I'm just naming a few that come to mind, then those could be more tactical on and off type strategies. This can fit as part of the core within a portfolio. We think that BlackRock has put it in as part of more of the core. It's important to note this is now a $4 billion ETF. So it's now on the radar of more investors, more advisors because of this. Many people have a cutoff of what they're comfortable with. So you might not have wanted to go into an ETF like THRO in the beginning of the year, but now because there's $4 billion invested in it, it's now perhaps worth taking a closer look.
It's Throw, THRO, the iShares U.S. Thematic Rotation Active ETF. The ETF for the week from Todd Rosenbluth at VettaFi. Todd, always a pleasure to chat with you. Look forward to doing this with you again next week.
I'll see you next week, Chuck.
That's Todd Rosenbluth. He's head of research at VettaFi. Go to VettaFi.com to dig into research on your favorite ETFs or maybe the ones you just learned about here on the show. And of course, Todd starts us out every Thursday, and we are just getting started on this show. Later, it'll be Market Call time with Kelly Wright from Investment Quality Trends. But up next, John Lekas from Leader Capital Corp makes his debut in the big interview. Stick around. This is Money Life.
Asset managers, you know how hard it is to stand out in this crowded space. VettaFi is a unique partner that can help you across the entire product lifecycle. With a best-in-class index factory and an award-winning digital marketing team, VettaFi can help you build the products of your dreams, optimize your distribution efforts, and grow your assets under management. Learn more at VettaFi.com.
Welcome to the big interview on the May 29th edition of Money Life. Joining me now for the first time, John Lekas. He is president and senior portfolio manager at Leader Capital Corp. And if you want to learn more about him and the firm, if you want to check out his insights, well, you should go to leadercapital.com. John Lekas, thanks so much for joining me on Money Life.
Great to be here. Thank you.
Let's start with the big picture. And I want to make sure my audience, because they're meeting you for the first time, understands that at Leader, you guys specialize on the fixed income side of things. And we're definitely going to get into what the bond market is saying. But you look at the big picture, you look at macro and geopolitical. So let's get your take right now. Are we getting to where we can feel comfortable with what we're going to get? Or we're just never going to get comfortable no matter what happens, good, bad, or otherwise, with this much uncertainty?
I mean, if I have to pick between the two, you're going to be uncomfortable for a while. However, the good news is, the equity markets probably finish from January plus 5 or 10%. And then in the bond market, we think yields go to 5% on the 10-year, 6% on the 30-year. Not the end of the world, but that's where we kind of see things ending up at the end of this year.
In terms of the ride it's going to take to get there, we've seen a lot of day-to-day volatility, obviously driven significantly by tariff activities. But for you, what are you expecting from the Fed? And are you expecting rate cuts? Are you thinking that we're going to wind up seeing the environment change significantly beyond the tariff situation when the Fed decides if it's acting or not acting?
Yeah, that's a complex question with the tariffs. I don't think people really appreciate what's going on there with the tariffs. I know that Trump puts it out there that we're at war with everybody. They're all ripping us off. But not all governments run the way the United States runs. We have an IRS, we have a tax system. We're a lot more organized. If you're in Zimbabwe, they don't have an IRS, they don't have a tax collector. So that government may run entirely on its tariffs. And that's something, I think people don't appreciate. And in the end, tariffs is just a tax. If you go to the store and you can buy a can of tomato juice for $1 and it's made in China, and you can buy one for 80 cents and it's made here, you're going to buy the one that's 80 cents. So in that case, China would lower its tariffs to compete. So it's all supply and demand. It's a competitive environment. The tariffs, it's not the at all. However, if Trump keeps, stirring that pot, yeah, you're going to continue to get volatility. On interest rate cuts, we've said for the last 2 years, the Fed is not going to cut interest rates. Why is that? If you look back at the last 2 cuts they had, the 10-year yield went up, meaning the bond prices sold off. 30-year yield went up. People say, "Oh, I don't understand that. It doesn't make any sense." Well, what doesn't make any sense is the Federal Reserve, and they should not be lowering interest rates in an inflationary environment. And that's exactly what they did, and that's the rub. So that's like throwing gas on the fire. So I think they've smartened up. They may go one cut politically because Trump's down, kicking them in the teeth every day. I think that's it. I think that's the conundrum that people are not appreciating. And I think that means inflation. We think inflation remains intact. It's not going away anytime soon. And what's exacerbating it mostly right now is the low dollar. And we are on a low dollar policy, 1, to pay off our deficit, but 2, to sell more goods and services overseas through exports. So the low dollar policy will keep inflation in play, but inflation is also good for equity. So it's not the end of the world, but we are on a low dollar policy. We think the dollar goes another 10% lower by the end of the year.
I think that's the part that when people were hearing tariffs and how these policies would work, they didn't recognize that in order to work, you have to have a weak dollar. And nobody talks about what it takes to go through a weak dollar, and that's not all that pleasant either. But along with the weak dollar, as an investor, we have some rising concerns about the currency. I don't want to go all the way to like panic scenarios, unless maybe you're already there with the dollar, losing its status as the world's primary reserve currency. But it is losing some status. So as an investor looking at this, is there a point where this impacts how you make decisions? And is that point now where the loss of status is real, even if it still seems kind of far away?
Well, okay, so I'll just answer that question about making decisions. We could, or a person could say, well, if it's a weak dollar, we'll invest overseas, easy money, right? But the currency volatility always makes that play too risky for us. So we recommend staying U.S. domestic. Losing our status as a reserve currency, and this is really a comment on tariffs as well as anything, really started with Janet Yellen and her sanctions on Russia. That was a terrible idea. It's still a terrible idea. All that did is gum up the financial system, and it allowed people to start trading Russian oil in euros, renminbi, rubles, etc. And that was the first real erosion of us as a reserve currency of the world. And that is one of the prices you pay when you put tariffs on people and you put sanctions on other countries. They get rid of their dollars, and you're seeing that in the weak dollar. They sell their dollars and they go into currencies where they can trade freely. So I am not for tariffs and I'm not for sanctions. That's too complex. And the end result is what you're saying, is that we could be unhooked as a reserve currency of the world. I will say that it's a pay-to-play deal, meaning we're the reserve currency of the world because we provide military protection for the world per se. And that's why people only trade commodities in US dollars. I mean, that's the way that's been for quite some time. Like I said, until these sanctions went on Russia. So it is a pay to play deal. That costs us about $400 billion a year to retain that status. But you are correct. I mean, there is a little erosion there.
Considering what you just said about sanctions and Russia and tariff policies and recognizing that we've got a war going on still in Russia and Ukraine, and we've got conflicts in the Middle East and heightened tensions in India and Pakistan, are your big worries more about the geopolitical factors and how they could reshape the world? Because they haven't really shown up that much in the market. They've made everybody concerned, but at least until now, they've been back burner issues. Are they going to just kind of stay there, or is this going to wind up being something that really reshapes the long-term picture?
I'm going to say not really, and I'm just talking financial. If Putin launches a tactical nuke tomorrow, it will have an impact. So, I'm not saying that's out of the question. However, if it continues on as it is, it will have a minimal impact. And quite frankly, it's actually been, as consumers of a lot of oil, the United States is, Russia's pumping oil till hell won't have it to fund that war, which has pushed that price down. So, there is some benefit there globally. We're not the only ones that use a lot of oil. About 95 million barrels a day get consumed. So I'd say as it is, status quo, it's not going to impact us financially, but it could get out of control. No question about it.
Let's go back to something you said earlier, where you talked about how you don't really want to go in the direction of international investments. A whole lot of folks that I've talked to recently say that the valuations are so compelling that that's where they really want to be, that they want to diversify their currency risk a little bit and do that by investing internationally in developed and emerging markets. You are completely content, basically, saying, I'm going to own U.S. multinationals, get my international exposure by owning companies based here that do business around the globe.
What you just said is exactly correct. The S&P 500 is the greatest country in the world. They do business everywhere. They're enormous. They're highly efficient. Let them take that currency risk on, and then you can benefit by, either higher yields, or if you want to own equities, you can benefit that way. But it's just too tricky. For example, like the tariffs, coming up. I mean, that's just out of the blue, but it can significantly impact you if you have money in the wrong place overseas, and all of a sudden they get hit with 100% tariff. So there's just too many political unknowns, too much uncertainty, and too much instability for us to want to do that. But like I said, people do it. We have done it occasionally, and I'll give you one specific we did. Is when we were in a negative interest rate environment, we bought euro bonds, and then we shorted the currency because it was a negative yield. We picked up an extra 125 basis points by shorting that currency, meaning the people on the other side had to pay us 1.25% extra. That took the risk out of the currency, and we ended up with the coupon plus 125. So I'm not saying I'll never do it. I have, but as a steady diet, that doesn't work for us.
Let's drill down a little bit on the bond market, because the stock and bond markets in the U.S. have been sending mixed messages. Stock market sending a message that says pretty much everything's fine, like we bounce back and it's all good. The bond market is saying not so fast. And as I've said multiple times, when the stock market and the bond market disagree, the side that's usually right is the bond market. You've already said you're not expecting the Fed to do much, if any, cutting this year. What message is the bond market giving you? And do you think that's the right message, and that people who are following the message of the stock market are following the wrong one?
Well, and they're actually, I'm going to say they're sending you the same message. We got inflation. That's what the bond market's telling you. We've got inflation. It's here to stay. And since COVID, we've got two kinds of inflation. We've got wage inflation, which is kind of new to me, something I hadn't seen before. And then we also have price inflation. And we haven't really seen the price inflation yet, but it will come with the lower dollar. That is going to ultimately drive commodity prices higher, because most commodities are traded in US dollars. The message the equity market's sending you is inflation's alive and well. That's what we're saying. The equity market, we think, is in good shape here. We think it'll end up plus 5 or 10% by the end of the year. We think yields on the 10-year treasury go to a little over 5%, 30-year bond a little over 6%. But you got to appreciate on that, that's a normal curve. 4 on the short end, 5 on the 10-year, 6 on the 30-year. That's a normal curve. That indicates a stable economy, unlike an inverted curve or a flat curve. So the bond market's telling you inflation, stock market's telling you inflation. Inflation's good for equities. Why? Because companies always raise prices more than the inflation, and so, it's an opportunity for them to increase profits. So we think they're both kind of telling you the same thing. I think where people have got it wrong is trying to predict the next recession. I mean, Chicken Little's coming anytime now. So we just don't buy into that. And we haven't seen it in the numbers. The numbers continue to tell us that inflation's intact, and we're going to have that the rest of the year. And if you do believe what I'm saying on a low dollar policy, that's inflationary. Your dollar's not worth as much. You have to spend more dollars to get the same goods and services. So I think they're more in tandem than juxtaposed.
Interesting, because that's not the common message. So you haven't seen enough evidence to think that a recession is coming. Do you worry that the uncertainty, the stuff that's going on, the headline risks, are actually going to make it a self-fulfilling prophecy? Or do you think that it's the guys like me in the media who were basically suggesting that recession's going to become a self-fulfilling prophecy?
Well, the guys in the media don't help that cause any. However, I do believe in numbers, and I do believe in science, and the numbers, if you just stay with the numbers, and we'll see what comes out of this next earnings period. But if you go with the numbers, you got to stay in equities. You got to stay on the short end of the curve in the bond market, if you believe those rates are going higher. And, I'm just not buying into the doom and gloom scenario. And I think this tariff thing will work itself out, because it didn't work. It's not working. I mean, it wasn't broke, and Trump tried to fix it. So I think that'll blow over. Yeah, we might have a few more headline risks, but by and large, I would say I think things are intact.
Given that, we talked about fixed income and how that's an area you really specialize in, but are there specific parts of the fixed income market that look particularly attractive? You've talked about where you want to be on the curve, but obviously there's a lot of different types of things in the credit markets these days. Where are you looking?
So the best risk reward and really the best performing part of the fixed income market the last, call it 2.5 years, has been the CLO market. And why is that? One, that market's gotten a lot bigger. And if you play in the A or better quality, which CLO is a floating rate instrument, collateralized loan obligation, it's a floating rate instrument. Mostly floating rate product or bonds are junk. But in the CLO world, I can get a quality floating rate piece of paper, and I can get paid 7 to 8% on that. That's pretty darn good, given the Fed funds is, hovering around 4%. So we've stayed in that market, and that's been the right place to be. And I think will be at least through the end of this year. We get paid well, we have good quality, we have excellent liquidity. And if you just match that up to corporate bonds, international bonds, treasuries, pick it, REITs, all of it, the risk-adjusted return there has been phenomenal. So that's primarily where we're invested right now. It doesn't mean we'll always be there. There'll be a point in time when we do want to extend duration, but it's just not right now.
John, really interesting stuff. I'm glad we got a chance to chat. I hope we get a chance to do it again down the line.
Thank you very much.
That's John Lekas. He's president and senior portfolio manager at Leader Capital Corp. Again, it's leadercapital.com if you're looking for more information on him or the firm, or you're looking for their commentary. Up next on Money Life, market call time. Kelly Wright, editor at Investment Quality Trends, will be here talking stocks when we come back in a moment. Stick around.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
Kelly Wright, editor of Investment Quality Trends, is back. We're talking stocks, and it's the market call. Welcome to the Money Life Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market, and how they put it all together. And returning to the market call today, Kelly Wright. He is editor at Investment Quality Trends. He's portfolio manager for IQ Trends Private Client, which does the Lucky 13. They are value investors with a long history, and that history dates back to the 1960s when Geraldine Weiss, who was kind of a legendary investment newsletter person, started this whole thing. Kelly's been running it for more than 20 years. And if you want to find out what he's doing, check things out and go a little further, IQTrends.com. Kelly Wright, welcome back to Money Life.
Chuck, thanks for having me. Always good to talk with you and your audience.
Well, we always start with methodology. And while I would think that there would be some members of my audience who are familiar, they don't remember everything that goes into it. And I said, you're value investors, but value is definitely in the eye of the beholder. So help us understand how you define value and how you define quality. Because by the way, you guys were using quality before it was a factor. Like, before somebody was going, hey, I want quality stocks. It's always been part of your moniker. So quality as a modern adjective may mean different things than what it's always meant at IQT.
Well, quality and value do mean different things to different people. Quality is our middle name. So this is like my 41st year in this business. And I've finally learned to break this down into the two concepts. If you're going to invest in stocks, it's about what and when. Those two words. What do I buy? When do I buy, hold, and sell? That's it. Everything else is just conversation. So what is the qualitative part of what we do? We have a very well-defined qualitative filter. It's 6 really old-fashioned Graham and Dodd fundamental measures like earnings persistency, dividends persistency, corporate sponsorship. 25 years of uninterrupted dividends is where the rubber really meets the road. And so we kind of pour the universe of stocks through that filter, and there's thousands, I don't know, 4,000 stocks. And we only come up with like 300, which actually can meet our qualitative filter. Now, so we have the what. That's the what part of the equation. Now it's the when. Well, what we have found over our almost 60 years, geez Louise, 60 years, is that our stocks, our high quality stocks, tend to have a shared characteristic, which is they tend to trade between 2 repetitive dividend yield areas. One where the price is low and the yield is high, one where the price is high and the yield is low. We've come up with these really fancy names called undervalue and overvalue. Undervalue is where you buy and you hold it until the price goes up and the yield declines to that overvalued area. So there's your what, and there's your when, rinse and repeat.
How much turnover does that typically give you? Because obviously what you're buying, you're hoping it's going to ride that wave. So classic value for many people is buy and hold as long as possible. In your case, if you're not holding, well, obviously, you could have something that maybe didn't fit the right profile or didn't turn out the way you wanted. How much turnover do you get? How frequently do you find that the market is doing something? Or is it in a market like this one where it's the Mag 7 are doing everything that everything else is kind of ignored and therefore undervalued for a long time?
Yeah, I mean, if you want to break it down to a metric, the average amount of time in our system for something to go from undervalue to overvalue is a little over 3.5 years. So there's a bell curve. 50% of the stocks cycle faster, 50% of the stocks cycle longer. We held McDonald's for 16 years. We bought it in 2003 and sold it in 2019 when they finally reached their high price, low yield area. Broke my heart, but as I tell our subscribers, we only date. We don't get married. But, I don't believe in buy and hold forever. I buy until we hold until we've wrung the value out of the stock. And then you say, thank you very much. You plant the flag, you take the gain, and then you go find a new undervalued stock. And that's how you stay out of trouble.
In terms of what you are seeing right now, this has been a market where for the longest time it was driven by very few stocks. Now there seems to be some broadening out, but are you at a spot where there's a lot of good value for you out there? Or since the market took that quick round trip, not a lot of value in a market that's still flirting with record highs?
So we break down our universe into four categories. One we call undervalued. That's the low price, high yield area. When a stock rises 10% above that, it reaches what we call the rising trend. When it gets to its high price, low value area, that's what we call overvalue. And then when it declines 10% from there, it enters what we call the declining trend. So our largest basket right now is the undervalued area, which I'm kind of surprised, but it's actually pretty well diversified. But the strongest stocks that I see in our undervalued area as a sector, it's kind of the staples, or some people would call them the consumer non-cyclicals. The financials, I see a lot of strength. There is some in healthcare, there's some in energy. So it's pretty well diversified right now in our undervalued area. The ones that I personally like right now, I like Imperial Oil. The symbol is IMO. It's like 65% owned by Exxon, which is too expensive. I wouldn't buy Exxon, but this is a cheap way to get around that. Imperial's in its undervalued area. Their return on invested capital is great. So is their free cash flow yield. And the market still has them a tad underpriced. Switching from energy, I like Merck in the healthcare area. Once again, Merck is the symbol is MRK. They're in their undervalued buy area. Once again, their return on invested capital is scorching. Their free cash flow is as well. But the market's got them underpriced by about 30% from what their economic book values were. D.H. Horton, the home builder, love them. They're right on the cusp between going from undervalued to a rising trend. It's still a buy. Once again, their cash flow internals are fabulous. Love that stock. I give you one more. Wyco Group. The symbol is WEYS. Look, it's a shoe company. All right. They make shoes, the kind of the lower to mid part of that market. They're at their undervalued area in terms of yield. They've got phenomenal cash flow internals. So there's an energy stock, a healthcare stock, a home builder, and then a consumer, discretionary stock. And all of those are buys.
You got all the ticker symbols in there except for DH Horton, which is ticker DHI.
Yeah. Sorry.
That's okay. The other side there, most of those names, except for maybe Merck, fall into the mid or small cap area. Given that we've been expecting small caps to rally and they haven't rallied, they're a very good place to be looking for value. But are you seeing the rally coming? Like we've been waiting for a long time, in spite of changes in conditions and a lot of things happening. Tariffs hit small companies at least as hard as they do big ones.
So I don't pay a lot of attention to cap size. All right. I pay attention to yield and cash flow. All right. Geraldine used to say there's hub caps, there's bottle caps, but we don't care about market caps because we're just looking for really high quality stocks that offer good value. And she said, as long as you do those two things, that we go back to the what and the when, everything else takes care of itself. So I'm not really worried about, I think all of that stuff's going to work itself out. The market is a machine that is designed to go up. And if it gets a wrench thrown in it, yeah, they may throw a temper tantrum. They'll have a fit. They'll stomp their feet and they'll go, okay, I got that out of my system. Now, how are we going to make money? Well, you're going to make money by finding what and when. What's good, and then when do you buy, hold, and sell it?
Let's talk about what has to change specifically when it comes to selling, because we talked a little bit about it. How much of it, or is any of it, that you find a potential faster horse? In other words, you're watching things and you want them to go from being undervalued to being properly valued. That would give you the opportunity to have a good run in it. But while it's making that journey, assuming that you want to be as fully invested as you can, do you ever look and you go, this one's been going slowly, this one looks like a faster horse, and change midstream? How much of it is about the company versus the other company?
So our optimum scenario is to hold 25 to 30 stocks as equally diversified as possible amongst the major industrial sectors, and all of them purchased in that undervalued area. My personal wildest dream is that each of those companies raises their dividend enough every year that they never get to their overvalued area. If I could build 25 to 30 stocks and never sell because they haven't reached overvalue, oh my God, I would. That's just fabulous. But that's not the real world. So, yeah, there is a tug of war that happens here, Chuck, where you look at your portfolio and you go, God, I'm pretty much fully invested and I'm chugging along. I got these. Do I really want to sell this to buy that? And that's, Benjamin Graham taught us something a long time ago. He said, every time you make a transaction, you got a 50-50 chance of doing something stupid. Don't be in such a hurry to sell a great stock. If it's cooking along, there's nothing wrong with its earnings, its dividend. They're just, yeah, they're doing their thing. They're sauntering along. Hey, it's all good. If you sell it, you might screw something up and make a mistake. So, but yeah, I get your question, and it's tough. It's a tough. I think you got to feel really, really convicted that, you know what, I think this can outperform something I already have. So yeah, let's make a switch. But that's a tough call.
Well, now we're going to get your quick and dirty take on some stocks that my audience is particularly interested in.
Quick and dirty.
I've got a good feeling about this.
Well, you should have a good feeling about it because, as you've heard Kelly talk about, you're looking at quality stocks with a reason to expect them to achieve their value. That's what it's all about at Investment Quality Trends, where Kelly Wright, my guest, is the editor. Go to iqtrends.com to learn more about what he's doing, to find out about IQ Trends Private Client, and more. Quick and Dirty is where we put our guests to your test. If you want to test our guests yourself, send your name, your hometown, and the ticker symbols you're interested in to chuck@moneylifeshow.com. We start with a request today from Ellen in Harbor Springs, Michigan, who wants to know about Farmers National Bank Corp. It is FMNB.
So, Ellen, the undervalued yield on Farmers is 2.75. It's currently trading at about a 5% yield. Its internals are great. It's trading well below its economic book value. It's a buy.
Money in the bank.
Yeah, money in the bank, in this case, FMNB, Farmers National Bank. And just out of curiosity, because of course you say you want to be diversified, are you finding a lot of good values in banking? I just got to know, because it is something we get asked a fair amount about.
Yeah, the financials, it's kind of diversified. I mean, I love a company called Globe Life. The symbol is GL. It's too expensive. I wouldn't buy it. There's a Federated Hermes, FHI. They're an asset manager. Love it. Too expensive. Wouldn't buy it. But things that I do like in this particular area, this would be one of them, FMMB, Farmers National. Off the top of my head,
I'll move us along, because let's move to a different financial stock that we've got a request for. Tom in Smithfield, Kentucky wants to know about AFG, American Financial Group, a different kind of financial services company.
it is indeed. Now, the undervalued yield on AFG, Tom, is 3.7%. It's currently trading at a 2.6% yield. It's got great internals, so it's a fabulous company. Right now, though, that's a sell. It's got about 35% downside before you get to your undervalued area.
The good news, however, is that the sell
And now for the profit taking.
is a profit taking because it got to where it was overvalued, right?
Oh, yeah, absolutely. Yeah, it's in what we call a declining trend. So, you planted the flag if you bought it in undervalued. Yeah.
So a sell on AFG, American Financial Group. Rick in York, Pennsylvania wants to know about MSC Industrial Direct Company. It's ticker MSM.
So once again, I'll cut to the chase. This is going to be a buy, Rick. The undervalued yield is 3.75%. MSM's currently trading at about a 4.25% yield. Its internals are fabulous in terms of return on invested capital and free cash flow yield. It's a tad pricey in terms of those internals, but it's a buy. I like that company. Matter of fact, MSN, I have to be honest, was a member of the Lucky 13 for 2025.
That's why we should buy now.
Yes, it is. That's one more reason to buy now. You got a few in there on MSC Industrial Direct, ticker MSM. Catherine in Fort Collins, Colorado, wants to know about ABM Industries. It's ticker ABM.
Yeah, Catherine, a great company. Right now, not a great stock. Undervalued yield is 2.7, and it's only trading at a 2% yield. It hit overvalue, and it's now in a declining trend, so that's a sell.
It's a sell on ABM Industries.
It's topped out. I say we sell now.
And last, for Richard in Chula Vista, California, it's C.H. Robinson Worldwide, ticker CHRW.
So, Richard, cutting to the chase, this is a buy. Great company. The undervalued yield is 2.9. It's trading at a 2.6, so you're right there in the ballpark. Great internals in terms of cash flow. Yeah, this is a buy. I like this company a lot.
So we finish on a high note with CHRW, C.H. Robinson Worldwide.
When you buy here, it's going up.
And that, of course, is what they try to do. Find that right thing with the right potential to go up at Investment Quality Trends. We've come to the end of our time with Kelly Wright. But Kelly, always great to chat with you. Thanks for taking the time to join me again.
Chuck, always appreciate the offer. Always good to talk to you.
Kelly Wright is editor at Investment Quality Trends, portfolio manager for the IQ Trends Private Client. They do the Lucky 13. Learn more at iqtrends.com. And we'll come back to put a bow on this show. We've got a little bit of crossover between Kelly and some other guests. We'll tell you about that. And then we'll cross the finish line together. We're back to wrap this one up. It is fun to have a market call. It's been a little while since we had one. That happens sometimes. We'll be back on a much more regular market call schedule as we get into June. As I told you, the time right around Memorial Day, both coming into it and right after it, a very difficult time. And again, not made easier by the fact that I lose a lot of my days at that point to officiating lacrosse games. The state tournament in Massachusetts was just announced yesterday, so we're down to the playoffs of the tournament, and I may or may not get an assignment or two in the tournament. You never can tell. Got a few last year, would expect to get them this year, but don't know. So we're coming to the end of that, but we're also getting towards the mid-year, which is a very easy time to book until you get to July 4th, which is crazy, and then the summer's not bad, what have you. But for all of that, the funny side is I can remember stocks being talked about. Like I remember we talked about C.H. Robinson Worldwide on the show. It didn't seem like that long ago, but it actually was not in the last 6 months. And that's all we do on Crossover. So we only had one stock in that interview with Kelly Wright that was about Crossover, and that was Merck, which, by the way, is in my portfolio. Peter Tuz from Chase Investment Counsel was buying Merck on April the 4th. Daniel Ducina from Blue Chip Partners was buying it on February the 28th. Craig Gaventer from Focus Partners Wealth was buying it on February the 3rd. And it was the poster child for Bill Smead from Smead Value back on December the 2nd. So that's where you had your crossover. By the way, so Kelly Wright has been editor of Investment Quality Trends for over 20 years, but he took it over from Geraldine Weiss, who only died in 2022. She was in her mid to late 90s at that point. But Geraldine Weiss is a fascinating story. She created Investment Quality Trends. She had the investment methodology that Kelly basically has followed up on, et cetera. But when she started, she published everything as G. Weiss because she didn't want anybody to know that she was a woman, because he felt they wouldn't take advice from a woman back in the 60s when she was starting things. So yeah, there you go. If you are looking for something to celebrate, well, it's May the 29th, 5/29. That means it's 5/29 day. And We don't normally celebrate those holidays, etc. But 529 plans, I mean, I can tell you I haven't had to look at one for a while because my kids have been out of school. And yet I will also tell you that becoming a grandfather, I will probably be looking to say, what kind of savings vehicle, am I going to help my kids save that way or do other things? Now, I will have a stock portfolio for my grandson when he arrives in terms of that's one of the things I plan to do. But 529s understand how they work because they are a godsend, and start saving early because that's going to be the best way you can cut into whatever you're going to be facing on the mountain of costs that is college. It's also National Paperclip Day. And then on the food front, National Biscuit Day. If biscuits and gravy are on the menu, I'm probably ordering them. It's also National Coq au Vin Day, which is, chicken and wine. Not a bad thing if you haven't had it in a while. It's one of those old classic recipes I brought back when I asked you guys what you were thinking I should make. My guests today were Todd Rosenbluth, head of research at Vetify, which is online at vetify.com. John Lekas, he made his debut on the show today. Let me know what you thought of him. Leader Capital Corp, he's president and senior portfolio manager there, leadercapital.com. And Kelly Wright, editor of Investment Quality Trends, iqtrends.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog, who spent most of his day in my office yesterday not doing that. But mostly thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Daniel Kahneman, who said, "Money does not buy you experiential happiness, but lack of money certainly buys you misery." Yeah, so you have to have some to at least be able to avoid the pain. We hope you'll avoid that pain and keep money in perspective. And remember that until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Go away. The party's over.